Good afternoon, everyone, and thank you for being here with us. As way of introduction again, seated on the extreme left is Colin from our IFAS research team with a fixed income portfolio manager, and we have Cyrus over here, who is a senior research analyst. So without further ado, let's dive into it, shall we? Coming into 2026, the consensus was for the Fed to keep cutting rates. 6 months later, we are debating rate hikes. What changed? And is it merely a geopolitical shock versus something more structural? Colin?
Sure. Hi everyone, I'm Colin. So great to be here again, seeing some familiar faces. So maybe to take your question, I would just like to take you guys through 6 months ago. So 6 months back, I think everything was quite peaceful. Everybody thought the Fed was kind of cruising towards lower rates. So steady cuts, a smooth ride, and the overall inflation engine was really coming down nicely. So two things got in the way. So one, the most obvious one is the Middle Eastern conflict and the blockage on the Straits of Hormuz. So energy prices spiked after that. So I'll just use an analogy. So think of that like suddenly driving down a stretch of desert. The outside temperature spiked and it pushes the engine of the car higher. So this is what I refer to as a classic external shock. So the external shock from the blockages and the spike in oil prices resulted in the inflation engine getting higher. So, but here's the second thing that really not a lot of people have actually caught on, which is the less obvious thing, is that the engine is already running warmer than it should have been before the war, before the conflict, and before it even hit the desert stretch I mentioned earlier. So that part was the external heat, but what has happened was that in the US labor market has been very resilient, and there have been certain factors that have been driving the inflation up over the longer trend, and that has resulted in the engine being already heating up before it even hit the desert stretch, and that desert portion resulted on the engine overheating to even more levels, and that is the point where people start to notice that smoke is coming out of the engine, which, to put it simply, they notice that the US inflation engine is starting to show signs of trouble. So overall, we can't really assume that the US inflation cycle will go back to what we've seen before that, which was the old inflation path, just because we are out of the desert now. So cooler air outside doesn't mean that the engine will go back to its normal temperature. So overall, when we look at the inflation pressure and how it has been and how it may turn out to be a bit more structural than what we expect for our portfolios, we do think that we should really think about how we're going to manage the duration aspect as well as the credit quality aspect of the portfolio.
Yeah, I absolutely agree with that. I think I won't repeat many of his points, which I agree with. I'll just add on that apart from inflation going up, so the number has clearly gone up over the past few months. But I also want to add that the uncertainty around future numbers has also gone up. So, for example, using his analogy of driving in a desert, for instance, I think it's not just that the ambient temperature is higher, it's also that simply riding on sand, it's going to be a more bumpy road ahead. It's going to be harder for anyone, including those in the industry, to forecast where it might be, 1 month, 3 months, 6 months from now. And of course, that's because of many factors in the background. You obviously have energy. You also have second-order effects from energy, like food, airlines. You also have, ongoing tariffs, whether they will come back or not. Lots of factors to consider. So that's the first thing. I think inflation uncertainty. Second is also another uncertainty, but it's on the Fed. So I think we might have seen in the last meeting, we have a new Fed chairman, Kevin Walsh, and I think what is perhaps safer to say is that this new chairman brings a different dynamic to the Fed. He has removed forward guidance, for instance. He didn't submit his dot plot, and I think basically what it just means is that it's going to be harder to divine what the Fed might do in the next meeting, next 2 meetings, and so on. Previously, if you read the Fed statement, you will see that they do provide some guidance on what the Fed is thinking and where they might act in the next meeting. Now that's gone. So basically, every data point is potentially a factor that goes into the Fed decision making, and it's going to be very difficult, much more difficult for markets to think about whether this data point is important or that it's important. Overall, more uncertainty.
Got it. So maybe a bit more structural, lots of uncertainty with regards to the Fed as well. So speaking of the Fed, if you had to bet on the Fed's next move, hold, cut, or hike by year end, what's your call, Cyrus?
I mean, I would describe my view as data dependent, but very, very clearly we are leaning towards hikes, so higher rates, definitely not towards lower rates. And of course, I say data dependent because I think in this environment, nothing is truly guaranteed. The Fed will still look at the data, data dependence and all that, look at, energy prices, oil prices, and also, for a consumer standpoint, CPI, right? Whether consumers are facing higher prices as well. Be it, gasoline, at a petrol station, are they getting higher prices? Has it come down and so on? So yeah, I think ultimately it'll be definitely about data dependence. And I think the question is on the Fed, but I also want to highlight that across the world, it's not just the Fed, right? Many central banks around the world, and many are clearly on the hiking path. We did publish an article saying there's been a turn in the interest rate cycle, and I think we are starting to see it play out. The RBA, for instance, this year in Australia has hiked 75 basis points. We saw earlier last month, in June, the ECB hiked once as well, 25 basis points. So yeah, overall, I think the global trend is clearly towards higher rates. Whether the Fed will hike or hold, I think it's going to be very data dependent, but we are clearly leaning towards higher rates, hikes.
Got it, got it. So since the oil prices peaked in March, there are still geopolitical risks involved. So how are you positioning your portfolio for geopolitical theories on your end, Colin?
Right, I think what has happened over the past week is kind of bad news for everybody. So looking at what has happened since the start of the war, oil moderating is good news, but I won't call it an all clear considering what has happened over the past week. So that was really a stress test of how fragile the energy supply chain is. I think if you look back across history, that's really one of the biggest disruptions the energy market has seen. So with that being said, what has happened there really has a tremendous impact on how we think about geopolitical risks. So right now, when we look at geopolitical risks, especially from that region, we see that as a recurring theme. We don't see that as a one-off where you just hedge and forget about it. So that has several implications on our portfolios, which I would love to share today. Firstly, I think it is on the duration management aspect. So for our portfolios, we keep duration shorter, and we keep it flexible. So rather than locking into longer tenors, which at this point in time are subjected to greater volatility. So I elaborate a bit on that. With energy prices rising, as well as the kind of inflation expectation also rising, and ultimately with the term premium rising, all in all, I think that puts a lot of upwards pressure on longer duration bond yields. So treasuries such as your 10-year, 30-year, for example, are facing more upwards pressure, and therefore they might face more price volatility at the long end as well. So that is something we try to avoid taking too much in our portfolios. But at the same time, if you look at the traditional role of fixed income, especially for let's say the 10-year US Treasury, a lot of people expect them to be hedged for equity, so to have inverse correlation. But little people know that during periods of high inflation, the correlation actually flips, and both of them are positively correlated, especially during this period. So this is exactly what you want to avoid, particularly in periods of high inflation. So overall, this is one thing we like to manage, duration aspect as well as being flexible on that. Second thing is when it comes to picking the underlying fixed income securities, we want to be more selective. So for our portfolios, we have actually trimmed exposure to Middle Eastern banks. These names are high quality names, but then again, a lot of these names are very exposed to the regional headline news. So that affected credit spreads. So credit spreads, simply put, is just the barometer of risk for the underlying securities. The higher the spreads, it reflects greater risk being expected of investors. So higher credit spreads compresses the price or push down the price, resulting in mark-to-market losses. So this is something we want to avoid as well. Also, while these Middle Eastern names are good names, good credit rating, they are subjected to the volatility of the news flow in that region. We do not want that. We do not want to avoid such situation. But conversely, for investors listening in, there are also ways to play this team. So by investing in fixed income products of the more insulated oil producers, your power infrastructures, as well as those names that are more insulated from the volatility in oil prices, you can benefit from this fragmentation rather than be hurt by it. So we have to see that both ways as well. And last and certainly not least, we try to stay disciplined on liquidity. And we do hold a portion of portfolio in very highly liquid products, such as your cash-like or your money market funds, for example. So this way we can reposition quickly if the market recovers, or if there is a big wave of redemption, we can manage that without being needed to force sell. That is ultimately something we want to avoid doing. But for investors listening in, the same idea applies. So being able to keep cash-like products or instruments on hand allows you to deploy when the market recovers, or to move more nimble instead of just scrambling at the last minute.
Got it. So be more mindful of your credit selection. Pay attention to liquidity as well, having your portfolio across both money market funds and bonds, and be mindful of duration. On that, how should investors think about short or long maturity bonds? Cyrus?
I mean, I think when it comes to short, medium, long maturity bonds, I think overall our preference is very clearly towards short and medium, so not really for long. But of course, when I say short to medium, it doesn't mean you just buy short or just buy medium. I think in your portfolio, you can definitely, there's room for a mix of products, right? You can have some short, so let's say your cash, sometimes 6-month T-bill auctions. And of course, you can have medium-term products, including your funds, unit trusts, bonds, and so on. So a bit of a mix of both, short and medium, not really long. I guess the overall idea is, the reason why we say don't go overly long is the overall idea is just to not go too crazy on duration, because interest rate risks are still there. So as Colin mentioned, at the start, there are still a lot of inflation risks, and I've also mentioned there's concerns that global interest rates are going up. The Fed itself also leaning towards hikes. So the thing is, if yields move higher, then your longer duration products will be more sensitive to this. They'll see larger price changes. Whereas if you stick to short to medium term bonds, yes, if yields fall, for instance, yuan is affected. But on the other hand, if yields increase, actually your downside is not that much. And plus the fact that all-in yields by themselves, for a regular US dollar bond, corporate bond, you can get 4 plus 5%. Considering the yields already provide this sort of a very solid base, right? I think overall it's really going to be something that's going to be just very steady, and something that you might expect from a fixed income portfolio. I'll just add on, even though I do like short to medium term bonds as a whole, of course I know there are different types of investors out there. So for those who are more, I'll say more like prefer more of trading bonds, then actually some of the long tenor bonds might be interesting, just as short-term tactical or trading ideas. So I know on our platforms, a bunch of our clients do actively trade, for instance, like your 30-year US Treasuries, or even for longer tenors, you can go to gilts, so UK government bonds, which go up to 50 years. And of course, you have some corporate bonds as well, by like your Google, Alibaba, Intel. So these are very large caps, right? Also about 30-year tenors. So if you are looking to trade on the interest rate movements and the price movements, then that is also an option for you. But I guess for a buy and hold investor, yeah, our preference is short to medium.
On to you, Colin.
Right, I think Cyrus did a good job summarizing the house view. So house view-wise is pretty clearly tilted towards short duration or short tenor bonds. So I think our portfolio positioning kind of reflects that as well. So I just want to add on very simply how we think, or how an investor can think about this risk. So think of it when you're buying bonds, you're kind of locking in today's interest rate over however long the bond runs, right? So a long bond, let's say 10 or even 30 years, is just like renting out your property over the long term and locking in the rent at today's level. So one day, if the rent continues to climb, has climbed much more, then you are getting underpaid, right? But at the same time, if you try to sell away that property, you're selling it at the rent level. Selling away the lease. The lease is having a rent that is lower than market level and you are getting paid at the discount. So essentially, this is what the exact risk of the going long bonds is right now. So persistent inflation as well as heavy government bond issuance have kind of put upwards pressure in prices, and therefore long-term yields are seeing an upwards pressure, leading to mark-to-market losses. So from an income perspective, when we look at long bonds, it is also the yields that they are giving us is also not that attractive as compared to the front end, where the shorter tenor bonds are seeing more increase in yields. So from that perspective, risk reward, we definitely prefer shorter term bonds, and which is essentially what our own house product, the IFAS US dollar as well as Singapore dollar enhanced liquidity fund sits. So we are very short tenor, high quality bonds, and that let us capture today's interest rate, rising interest rate, without even locking in or having the need to lock into longer maturity. And if yield keeps rising, we will just roll over to higher yielding products as well. But we also allocate a portion of this enhanced liquidity fund into very liquid T1, T0 products, which you can redeem almost within the same day, even on the next day itself for this underlying product. So liquidity stays high. They are being allocated to solid, high-quality bonds. So to be clear, this is a product that is offering high liquidity and with exposure to very short tenor bonds. And these are essentially the areas we like. So if you look at the longer duration bonds, like what Cyrus mentioned earlier, we are not calling it, we're not against investing in longer duration bonds. So if you're an investor who has a view that interest rates are coming down because for whatever reason you think, maybe if you think the macro environment is weakening and Feds need to cut rate, I mean, that is a decent approach to execute your view. But also, if you are an active trader, you want to play the price volatility at the longer tenor duration. Longer tenor bonds could also be your preferred products. So ultimately, I think it is how we view this long versus short duration, and our view that makes us gravitate towards shorter duration bonds. But if you do have a view that supports a longer duration call, I think then that perhaps would make sense for you as well.
Thanks, Colin. Let's delve a bit deeper now. Investment grade spreads are currently sitting near multi-decade tights, and even after the Iran shock, they have still stayed at these levels, while high yield spreads have widened more sharply and hasn't yet round-tripped. So in this case, do you prefer investment grade or high yield? Colin?
Thanks, Wesley. I think this is a great question because this is a lot has been said on investment grade versus high yield in this current environment. And I just think that it is with what has happened recently and how credit spreads are very tight. This is a very apt question to think about at this point in time. So for a while, we have been positive on investment grade bonds, and I think that the reason that underpin this is the fact that despite credit spreads for investment grade bonds being very tight, so what this means is things are priced for perfection. We do think that the investment grade bonds, they justify to a certain extent this tight credit spreads, because if you look at credit fundamentals, the health of all these investment grade companies, they are actually very okay. Earnings are very robust, decent coverage on interest payments, and then debt management has been very prudent and throughout the post-COVID cycles, and we have seen overall very good conditions for these companies, which we can understand why credit spreads are very tight for this. But on top of that, if you look at investment grade bonds, they are still paying you very decent yield despite the rate cuts. I believe Cyrus mentioned earlier on that 4 or 5% then investment grade bonds can pay you. So for example, if you invest right now in a US dollar, investment grade bank bonds that mature within 5 years, you can easily get 4.5 to 5% or even above for some of these names. So that is still very good, sustainable, high quality yield for investors to look for and look at. But high yield bonds, on the other hand, are really not offering enough yields right now, not offering enough compensation for us to dip our toes into it. So if you look at on a historical perspective, on average, investing in high yield bonds over choosing high yield bonds over choosing investment grade bonds should pay you close to 3.8 to 4% yield higher. But right now it is only paying you about 2.5 to 3%, I believe. So yeah, what I'm trying to say is you are getting underpaid for taking that risk. So we prefer not to dip our toes into these high yield bonds in an overwhelming manner. Selective is okay. So overall, that's how we kind of think about high yield versus IG. We do like IG. We do think that investment grade bonds should form a core part of a portfolio. And if you have the risk appetite and the risk bucket to allocate to higher riskier bonds or high yield bonds, then do consider selective high yield bonds issuers, especially turning those in opportunity lies more in those double B names than reaching down to the triple C names. But ultimately, the issuer will matter more.
Yeah, I agree with that generally. So you know what Colin said that difference in yield between a junk bond and an investment grade bond, right, is actually not much today. So yeah, overall the risk reward on average on a market level, yeah, we do prefer IG. And of course, if you read our articles, you can see that we have way more IG recommendations versus high yield. So yeah, this is generally what we are recommending. But with that being said, what Colin said about being selective also matters a lot. So even though on average we write more IG ideas, right? But I think there are quite a number of high yield, bond ideas that we have talked about as well. They're pretty interesting. For instance, we have been talking about Petrobras bonds for some time, and of course, this is a beneficiary of if oil prices go up, this will be a beneficiary. We have also talked about companies like Block, which is a fintech leader in the US, and of course, we more recently talked about SoftBank bonds, 7+% yields in US dollar terms. So yeah, I think the crux, right, is really about identifying the correct balance between risk and returns. So it's not that high yield is all bad or IG is all good. It's ultimately deciding whether you are willing to take the additional risk for higher yields. I also add one more point on the Sing dollar market, because for the investors here who only do Sing dollar bonds, right, you might know that a lot of Sing dollar issuers are not rated. So if let's say you go into the bond market thinking I must get an investment grade bond, then unfortunately your universe is not going to be very big. Your opportunity set is quite small. So in this case, I think it really comes back to the original point, right? Issuer bond selection is extremely important, making sure that you are comfortable with each company's risks. And if you are comfortable with the risks and opportunities, you balance it against the yield, and then you can make a decision on what's good for you. So for us, for instance, we have talked about a number of, I would say, unrated bonds. So they are not investment grade, not high yield rated as well. Something like your Cole Brothers, SPO, 4.5+% in Sing dollars. We have talked about perhaps lower yield, but also safer names like Hobie Land, which is around 3% as well. And of course, I think the list goes on and on. But the point, once again, that I want to highlight is that it's ultimately not looking at the official credit rating by Moody's or Fitch or whatever, but evaluating on a company-by-company basis what is the risk and what is the potential reward from it. And from there, you can pick the best bonds out there.
Thank you, Cyrus. On that note, for an SGD-based investor, do you recommend sticking with SGD bonds, or is there a case for diversifying to other currencies?
Well, I think, I'm just going to generalize and assume you are, Singapore-based or Singaporean investors. So, for the average Singaporean investor, I think Sing dollar bonds would still be the key anchor. And the key reason is quite simple. Most of your, your income requirements or your, whatever retirement goals you have, they are mostly in Sing dollar, assuming you plan to retire in Singapore, of course. And because of that, generally to reduce the currency risk, you'll want to keep it in Sing dollar as well. However, of course, other bond markets, especially US dollar bond markets, do have some benefits as well. So if you're comfortable with all the FX risks, dollar Sing FX risk, then I also want to highlight that the dollar bond market is significantly deeper and larger than Sing dollar bond market. So you have way more opportunities out there, different issuers coming to market, different tenors and so on. And of course, the yields on an unhedged basis are also higher. So again, I think it's probably going to be a theme I'll be many times today, but is about balancing the potential risk and reward. On the risk side, for a non-Sing dollar bond, it's going to be, obviously FX risk for a Singaporean investor. But of course, for a global investor, if you're not really based in Singapore per se, and you're willing to earn higher unhedged yields, gain access to a larger market as a whole, then yeah, definitely the US dollar bond market might be interesting too.
Thanks, Cyrus. Now with spreads tight across multiple bond segments, does active management matter more or less now? Colin?
Right, I think this is a great question. But much more, I would say, going active here is perhaps one of the clearest call we have in a while. So when spreads are sitting near multi-year tights, owning a passive credit index would mean that you're getting paid less and less for the credit risk you're taking on, while still being fully exposed to the underlying names. Because again, you're buying into a basket, which just passively investing back into the index. So that is exactly the environment where when credit spreads are tight, careful selection is more important. But at the same time, when we look at certain environments, certain sectors, we can see that there's dispersion that is happening. So the AI-related value chain, for example, when you look at credit spreads and balance sheet between your hyperscalers, your chip makers, and even some of the other smaller companies like data center companies, for example, they have kind of diverged sharply. So we have the good ones and we have the bad ones. So this all happens even though at a broad level, the growth theme is still going on very strongly. So that is kind of the opportunity for active manager to come in and do their homework and pick the good names, despite in this dispersion. Whereas for passive investors who may end up owning the whole basket, owning the strong and the weak, so end of the day, they might not be able to perform that well. And that's the second point. So lastly, I just want to highlight a quick risk that's worth flagging when the spreads are very tight. So when spreads are tight, like I mentioned, I think a few questions back, things are priced for perfection. Things are priced for a perfect outcome. Yeah, so this is similar to high valuations, which is pricing in a good and perfect outcome, right? So this actually leaves very little room for bad news. So if a corporate fundamentals or credit fundamentals weaken, so the company's fundamental actually weakens, it will often take time for credit rating agencies to catch on and reflect that. And by the time that happens, we may see spreads blowing up. But for an active manager who has done his or her credit flow homework, they can actually see and move before that, reposition before this actually happens, before the rating agency actually reflects that. And which means they could have benefited from that much earlier on. And for a passive indices, on the other hand, they may mechanically hold on to those names until the certain downgrade happens to the credit index. So overall, these are kind of just three areas which I see that have kind of supported the case for active management.
Thanks, Colin. For investors who have fixed income exposure today or are looking to rebalance their portfolio to include fixed income, how would you recommend balancing the different products out there? Colin?
Okay, I will think about this in layers. So for example, let's start with the core of the portfolio. So at the core, we do like short to medium term bonds, and we do like high quality investment grade bonds as well. So this is where something like our iFAST eSpring Lion Bond Fund fits well. It gives investors high-quality names to exposure to the Asian bond market while not taking on excessive duration risk. So that is your anchor. That's not the whole portfolio. So this is where a good bond fund can fill in the gap. So around the core, what we think about at the peripheral area are the rest of your allocation. So we would add exposures more selectively. First, I think you can consider high-quality investment-grade names here. So you can afford to take a bit more of a duration risk here since you're going high quality, you're not taking that credit risk. So higher tenors, high quality investment grade bonds that can give you actually higher yields would definitely fit in here. But also if your risk appetite, risk bucket allows, I think selectively adding some high yield bonds within this area also will work. And do keep in mind, I think, which is our house recommendation, is to keep the duration short if you are intending to add high yield exposure and not to be exposed to risk on both credit front as well as duration front. And ultimately, to finish off at the last area is to maybe add a bit of a liquidity layer there, so which is to add exposure to cash-like products, your money market funds, or even funds like the IFAS Enhanced Liquidity Fund, to that area to ensure that you have that daily liquidity to capitalize when markets improve or when markets comes down, you can reposition quickly. So overall, those are the layers I would think about. But the honest answer is just to match the products to the job. So for example, liquidity, you match it to the enhanced liquidity fund. And for sustainable income, you match to the investment grade bond funds, for example.
Yeah, I'll just add on a little more on this. So I think Colin has described like sort of what to invest in. So short to medium, high quality, and then a bit of liquidity as well. So I'll just add on maybe one quick point on how to invest. And I think one way you can consider investing into bonds is to use a laddered approach. So this applies for individual bonds, right? Let's say if you are looking to buy over a 5-year period, you don't need to buy all 5-year bonds. What you can consider is buying perhaps one 1-year bond, one 2-year bond, one 3-year bond, one 4-year bond, and then one 5-year bond. And if you do that, then what you will get is a constant flow of maturities. Every 1 year, you have a consistent sort of income coming in, rather than a big lump sum all the way at a certain point, at year 5 itself. So if you build a ladder of year 1, 2, 3, 4, 5, and so on, and that could satisfy your income requirements for the fixed income segment.
Thank you, Colin and Cyrus, for your views and your insights today. Maybe one last question before we end our discussion today. What is one thing our audience should watch between now and the next FOMC meeting in September that would change your views? Cyrus?
So I think for us, we look a lot at individual, corporate bonds and some sovereign bonds as well. And it really comes back to this one single point that I've said a few times, which is to balance your risk and reward. So for me, what I'll be looking at, up to the September meeting and beyond, is to look at credit spreads and fundamentals. Two things, but linked to each other. Now, as Colin has mentioned, credit spreads are tight today, but that is also because companies are doing well. Fundamentals are doing fine. So as long as they are constantly making cash flows, earnings, they can easily get refinancing in the future or later in this year. So if that works out, that's all good. But what we'll be watching for is any sort of dislocation or divergence. If, let's say, credit spreads remain tight, but we also see fundamentals weakening, then that will be something concerning to us, because ultimately the spreads should follow the fundamentals. The risk should follow the reward. So that is what we are looking for. Any change in this sort of risk-reward, balance.
Right. Just to supplement, in terms of, if you're looking at data point, right? In terms of data point, really two different areas I'm actually looking at. One is on the labor market front, the other one is on the inflation front. So on the labor market front, very quickly, I'm looking at the payroll data, see whether the expectation of the 100K average monthly payroll growth is being hit or not. And that could tell investors a lot on the health of the labor market, whether it is actually overheating, being resilient, or whether it's actually fading below the surface. Then on the inflation data front, I'm looking at core services inflation, to see whether to see whether the energy-driven inflation has bled into some of the structural factors that forms the services inflation, and whether that will hold on a month-to-month basis, or whether that will kind of fade. So overall, looking at these two data, it will give investors a more clear idea on whether inflation is structural or not. But I tend to believe there are some structural factors underpinning inflation, and therefore, I mean, the interest rate journey ahead might not be the smooth one. I would just say it could be a bumpy journey that we all should be prepared for.
Right. That will be the end of our discussion about fixed income today. Hopefully you took some insights from it. Once again, thank you, Colin and Cyrus, for sharing your views.
Thank you.